Research in Motion shows some positive signs in its second quarter earnings report. Yes, sales at the BlackBerry maker are still dropping, falling 31% to $2.8 billion in the quarter. And the company did post a net loss of $235 million, down 171%. However, those numbers were better than forecast, and RIM is showing some solid growth in Africa and Asia. And it comes just 2 days after RIM gave a sneak preview of its new BlackBerry 10 operating system, which is expected to finally be available early next year. All this is helping RIM to rise in after-hours trading. For more on the numbers, I want to bring in our Corey Johnson with the drill down. Corey?
Yeah, well, what's going on with Research in Motion has been really a big shock over the last couple of years. If you look at the big sell-off in this company, since really about 4 or 5 years ago when it came to dominate the smartphone business, we look at these results today to see what's going on. And while the market seems to like it, if you look at the stock rebounding after hours, what we see from the company actually maybe isn't such good news with a greater perspective. Sales growth, among the things we need to look at here. What we see from sales growth of this company is really something of a disappointment. We see sales, I say disappointment. Disappointment if you want the company to grow. Wall Street seems to be pleased with this, but 43% year-over-year sales growth, and that is a sales decline, that's bad news. The profits as well, also, while somewhat better than what Wall Street had hoped for, the company losing a lot more money than they have been in the past, losing $600 million in the quarter. That'd be $0.6 billion, of course. So really a great concern for this company in the sense of profits being smaller, revenues so much smaller. While better than Wall Street expected, no one can call these results good.
All right, but Corey, is there any sense that this smaller business for RIM, as you describe it, is the better part of the business?
Right. I mean, one might think that they'd say, hey, we can't be everything to everyone, so we're going to focus on the places where we can make the most money. That's one kind of turnaround. But if you look at the margins for this company and what we've seen about the gross margins for the company, again, you see a very steady, this isn't a one-time thing. Over the course of the last 6 quarters, margins have gotten worse and worse, lower and lower. And the result of those falling margins is it makes it harder for this company to make money, yes, in the current environment. But the other concern here is not just that margins are worse, is that they're focusing on a part of the market where they can face a lot of competition, other low-cost players that may compete with them.
Corey, anything hopeful here?
There's some hopeful things. Cash, for example, the company's been able to sock away a lot of cash, and they seem to have prepared themselves for this. Is the cash position for the company a little bit better than it's been and steadily improving? It looks like they may have seen what some of those issues are and being ready for them by stockpiling cash.
And they said, Corey, that they shipped 7.4 million BlackBerries in the quarter. That's good news, right?
It's got to be good news for the company. And one of the other positive signs is inventory. It's if you look at how much inventory they've got in hand and then the cost of goods over the previous 91 days, that will show you what's called days of inventory. And the days of inventory is something that's closely watched. If you look at the June over June, which I think is the right way to look at it, you see last June, 41 days of inventory. This June, or the quarter ending in June, 34 days of inventory. So that's an improvement. That means they're getting rid of the old junk. And technology, this is really important because, as we know, an old phone is a worthless phone. For them to have only 34 days of technology in parts and finished goods, that's a good thing for this business.